Hey everyone, welcome back to Ananta Wealth Management. Today we are diving into few important topics in life insurance. Modified endowment contract, viatical settlements, transfer of value, accelerated death benefits, taxation of life insurance. Let's get started. So what is a modified endowment contract? Imagine your life insurance policy has a speed limit for premium payments every year. If you go too fast, that is, if you pay too much into your policy within 7 years, the IRS throws a red flag and calls your policy as a modified endowment contract. Here is the kicker. Once your policy becomes a MEC, you face some serious tax consequences. So, what are they? Your withdrawals get taxed as ordinary income. You might face a 10% penalty if you are under 59 and a half years old. Your death benefit stays tax free, but you lose other valuable tax perks. So you need to understand LIFO and how LIFO works with MEC here. So LIFO stands for last in, first out. Last in, first out. Think of it like a stack of boxes. You take from the top first. In insurance terms, this means the most recent money you put in is considered the first money you take out. For regular life insurance policies that aren't MECs, LIFO is your friend. Here is why. Let's break down with an example. Imagine you have $10,000 in your policy. Out of those $10,000, $7,000 are premiums you paid and $3,000 are your gains. Let's take scenario number one, which is a non-MEC policy. If you withdraw $5,000 from your policy, thanks to LIFO, you will be only taxed on $3,000, the gains. The remaining $2,000 comes from your premiums as tax free. Let's take scenario number two, MEC policy. It means a policy which is classified as a modified endowment contract. Here, you withdraw $5,000 as from the previous scenario, but the surprise is the entire $5,000 is taxable. Why? Because MECs ignore LIFO and tax all gains first. That's the difference between a MEC and a non-MEC policy. The key takeaway here is MECs happen when you overfund your life insurance policy and you lose LIFO tax benefits, making all gains taxable first. If you are managing a life insurance policy, it's crucial to consult a tax advisor. They can help you avoid accidentally classifying your policy as a MEC and clarify how these LIFO and FIFO rules apply. Let's tackle the 7-pay test and the corridor test. These are crucial for understanding how your life insurance policy is taxed. So let's get started. A MEC is essentially a life insurance policy that the IRS considers to be overfunded, shifting its primary purpose from life insurance to more of an investment vehicle. This can have some serious tax implications, so it's important to understand how these tests work. First, the 7-pay test. This test looks at how much you pay into your policy in the first 7 years. The insurance company calculates a specific limit for your policy, the maximum amount you can pay in those first 7 years without triggering MEC status due to this test. If you pay more than that 7-pay limit in the first 7 years, your policy immediately becomes a MEC. This is very crucial. It doesn't matter what happens with the cash value or the death benefit later on. you have failed the 7-pay test and you are a MEC if you have overfunded. Now, if you pass the 7-pay test, meaning you paid less than the limit in those first 7 years, you're not a MEC yet. But there is still one more hurdle, the corridor test. The corridor test is all about the relationship between your policy's cash value and its death benefit. It ensures there is a sufficient gap or corridor between the two. The IRS has rules about how wide that gap needs to be, and it's based on your age. Essentially, your death benefit has to be a certain percentage higher than your cash value. As your cash value grows over time, your death benefit needs to maintain that required gap. If your cash value grows too much and your death benefit doesn't keep pace, you can fail the corridor test. And if you fail the corridor test, your policy becomes a MEC. This can happen years down the line, even if you pass the 7-pay test initially. So remember, either failing the 7-pay test or failing the corridor test will make your policy a MEC. The 7-pay test looks at your early premium payments, while the corridor test looks at the ongoing balance between the cash value and the death benefit. Here is a quick recap. The 7-pay test focuses on premiums paid in the first 7 years. The corridor test focuses on the relationship between the cash value and the death benefit over the life of the policy. You fail either test and your policy becomes a MEC. MEC tax implications have uh, different tax rules for withdrawals and loans. So it's essential to understand these tests. And let's look at some of the other disadvantages and advantages. In practice, MEC treatment is only disadvantageous for those policy owner who intend to borrow from the policy. If you never intend to borrow, then having a MEC is of no consequence. Even with MEC, benefits remain income tax free to beneficiaries. Despite tax implications, MECs can be a powerful tool for the right person. Let's dive in. We know MECs are taxed differently than traditional life insurance policies, but that doesn't automatically make them bad. In fact, for certain financial situations, a MEC can be incredibly advantageous. First up, tax deferred growth. Just like other permanent life insurance, the cash value inside a MEC grows tax deferred. This means you don't pay taxes on the interest, dividends, or capital gains until you actually withdraw the money. This can lead to a significant long term growth. The other one and the bigger one is higher contribution limits. Unlike 401ks, your traditional IRAs or Roth IRAs, MECs don't have annual contribution limits. You can contribute as much as you want. This makes MECs very attractive for high income earners or anyone who has already maxed out their other retirement accounts and wants another tax advantaged vehicle or investment vehicle. Moving on to the estate planning benefits. The death benefit from a MEC is generally income tax free to your beneficiaries. This is huge for passing wealth to your heirs. But or plus with proper planning, a MEC can even help reduce estate taxes. Another often overlooked benefit is asset protection. In many jurisdictions, the cash value and death benefit of a life insurance policy, including a MEC, are protected from creditors. This is a major advantage for business owners or professionals in high liability fields. Finally, no mandatory withdrawals. Unlike some retirement accounts, MECs don't force you to start taking distributions at a certain age. This gives you maximum flexibility. You can control your cash when and how you access your money. Now, let's explore the cons. MECs aren't always sunshine and rainbows. There are some serious drawbacks you need to know before you even think about getting one. MECs have stricter tax rules and for good reason. They are designed to prevent people from using life insurance primarily as a tax sheltered investment vehicle. So let's look at the downsides. First, and this is a big one, taxation on withdrawals. With a MEC, any withdrawals or loans are taxed on a last in, first out or LIFO basis. This means the IRS considers you to be taking out the gains first, not your original contributions. So, if your policy has built up a lot of cash value, you will be paying taxes on that growth before you touch any of the money you put in, that is your premiums. And it gets worse, early withdrawal penalties. If you are under 59 and a half and you take money out of a MEC, you are not just paying taxes on the gains, you are also hit with a 10% federal penalty. This makes a terrible choice if you think you might need access to the cash before retirement. Another disadvantage is loss of favorable tax treatment for premiums. With a regular life insurance policy, a non-MEC policy, you can sometimes access your contributions tax free. Not so with a MEC. The tax advantage on your initial premiums is gone. Next is complexity and monitoring. MEC's rules are complicated. You have to be super careful about how much you pay in premiums to avoid accidentally turning your policy into a MEC. This can be really headache and might even require you to hire a professional to help you manage it. Finally, and this is a major drawback, inflexibility. Once a policy becomes a MEC, it's always a MEC. You can't go back. Even if you reduce your premiums or stop paying altogether, that MEC status is permanent. This really limits your options if your financial situation changes. So, as you can see, MECs have some serious downsides. The tax implications, the penalties, the complexity, and the inflexibility can make them a poor choice for many people. Uh, MECs are not definitely a one size fits all solution. They might be right for very specific situations, but for most people, the drawbacks outweigh the benefits. Before you consider a MEC, talk to a qualified financial advisor. They can help you determine if it aligns with your financial goals. Let's look into viatical settlements. If yourself or a loved one are facing a terminal illness and need immediate access to cash, this might be an option worth exploring. It's not an easy subject, but it's vital to understand. Viatical settlement is essentially the sale of your life insurance policy to a third party company. These companies specialize in buying policies from people who are terminally ill or have a shortened life expectancy. Uh, they provide a lump sum cash payment which can be used for medical expenses, living costs, or anything else the policyholder needs. Now, the key difference between a viatical settlement and simply cashing in your policy with the insurance company is who you are selling it to and why. Viatical settlements are specifically designed for those with a limited life expectancy. Remember this. And here is a crucial benefit, especially during a difficult time. The proceeds from a viatical settlement are often tax free. This is a significant advantage compared to other ways of accessing funds from a life insurance policy. The IRS generally treats the money you receive from a viatical settlement as an advance on your death benefit. Because death benefits are typically tax free, the viatical settlement proceeds are often too. This makes a huge difference in how much money you actually receive and how you can use it. To qualify for a viatical settlement, you typically need to be certified as terminally ill. This generally means having a life expectancy of 24 months or less. The Viatical settlement company will review your medical records and may require an independent medical examination to determine your eligibility. It's important to understand that the amount you receive from a viatical settlement will be less than the policy's face value. The viatical settlement company takes on the responsibility of paying the premiums and receives the death benefit when you pass away. So they need to factor in those costs and their own profit margin. Viatical settlements are not for everyone. They are a complex financial decision that should be made carefully. It's essential to consider all your options, including any other financial resources you might have. These settlements can provide much needed financial relief during a challenging time, but it's crucial to understand the process, the tax implications, and the potential impact on your family. If you are considering a viatical settlement, do your research, check and choose a reputable viatical settlement company and seek professional guidance or advice. This is a significant decision and you deserve to have all the information you need. Did you know that in some cases, death benefit can also be taxable? Let's dive into an important concept called transfer of value rule. This rule could impact your life insurance policy, so pay close attention. Generally, life insurance death benefits are income tax free to the beneficiaries. That's one of the major reasons people buy life insurance. But the transfer of value rule creates an exception here. It's designed to prevent people from using life insurance to avoid taxes on assets. The transfer of value rule comes into play when you transfer ownership of a life insurance policy while you are still alive. If that transfer happens within 3 years of your death and the policy is then paid out, a portion of the death benefit could be subject to income tax. Specifically, the amount that's taxed is the difference between the death benefit and the amount the new owner paid for the policy plus any premiums they paid after the transfer. Think of it this way: the IRS wants to tax any gain realized on the policy after it was transferred. Let's illustrate this with an example. Imagine John owns a $500,000 life insurance policy on himself. He sells it to his friend Sarah for $50,000. Sarah pays the premiums for the next 2 years, totaling $10,000. John then passes away. The death benefit is $500,000. Sarah paid only $50,000 for the policy and $10,000 in premiums for a total of $60,000. The difference is $440,000. This $440,000 could be subject to income tax. Now, are there any exceptions to this rule? Yes, thankfully. There are a few situations where the transfer of value doesn't apply. Some in scenarios, like some exceptions are transfer to a spouse, like transfers to your spouse are generally exempt. Transfer to a business partner. If you transfer to a business partner, those gains are those benefits are often exempt. Transfer to a charity is also exempt. Bona fide sale. If the transfer is a legitimate sale for fair market value, it might be exempt, but this is complex and requires careful domination. The transfer of value rule can be complicated, and it's essentially to understand how it might affect your specific situation. It's designed to prevent tax avoidance, but it can also have unintended consequences if you are not aware of it. If you are considering transferring ownership of a life insurance policy, please talk to a qualified financial professional or your tax advisor. They can help you navigate these complex rules and ensure you are not hit with unexpected tax liabilities. Sometimes life throws unexpected curveballs, and you might need access to cash quickly. If you have a life insurance policy, there is a provision that could help called accelerated death benefits. Let's break down how they work and how they can provide financial relief during difficult times. An accelerated death benefit is a feature built into many life insurance policies that allows you to receive a portion of your death benefit while you are still alive. This is especially helpful if you are facing a qualifying condition such as a terminal illness or a chronic condition requiring expensive treatment. Think of it as accessing your life insurance early. Instead of your beneficiaries receiving the entire death benefit after you pass away, you can receive a portion of it now when you need it most. The process is relatively straightforward. If you are diagnosed with a qualifying condition, you can file a claim with your insurance company to accelerate a portion of your death benefit. The insurance company will review your claim and determine the amount you are eligible to receive. It's important to note that the amount you receive will be deducted from the total death benefit. So, when you pass away, your beneficiaries will receive the remaining amount. And here is the crucial point: the accelerated death benefit you receive is generally income tax free. This is a huge advantage, especially when you are dealing with medical expenses or other financial burdens. The IRS typically treats these accelerated payments as an advance on the death benefit, which is usually tax free. Accelerated death benefits are similar to Viatical settlements in that they provide early access to funds from a life insurance policy. However, there is a key difference. With an accelerated death benefit, you are dealing directly with your original insurance company. Whereas in Viatical settlement, you are selling your life insurance policy to a third party company. Both these options can provide needed cash, but they have different implications. It's crucial to understand the distinctions between them. The Tax Cuts and Jobs Act of 2017 (TCJA) made some changes regarding the life insurance policy sales, including Viatical settlements. It introduced reporting requirements for certain sales and clarified the rules for determining the basis of the policy. While this mainly affects Viatical settlements, it's good to be aware of these changes. Accelerated death benefits can be a lifeline for those facing difficult health situations. They can provide access to cash when it's needed most, and they are usually tax free. Life insurance is a crucial part of financial planning, but understanding the tax implications can be tricky. Let's tackle these two questions. Are life insurance death benefits taxable? And what about estate taxes? Let's break it down. The good news is that generally life insurance death benefits are not subject to income tax. This is a huge advantage and one of the primary reasons why people get attracted to this. When the insured passes away, the beneficiary receives the death benefit, and that money is typically tax free. This allows your loved ones to receive financial support without worrying about immediate tax burdens. And what about the cash value of the policy? Well, if the insured passes away, the cash value is also not taxable. It's considered part of the overall death benefit. So, to recap, death benefits and the policy's cash value at death are generally income tax free to the beneficiary. Now, here is where things get a bit more complex: estate taxes. While the recipient of the death benefit usually doesn't pay income tax, the death benefit itself could be included in the deceased's taxable estate. If the deceased owned the life insurance on their own life, or if the proceeds are payable to their estate, the death benefit will be included in their gross estate. And if the total value of their estate exceeds the estate tax exemption limit, the estate taxes may be due. Let's illustrate with an example. Imagine Sarah owns a $1 million life insurance policy on herself. When she passes away, the death benefit is paid to her children. This $1 million will be included in Sarah's gross estate. If her total estate, including the life insurance proceeds, exceeds the estate tax exemption, her estate will owe estate taxes. It's important to understand that the estate tax exemption is quite high, so many people won't be affected. However, for those with larger estates, it is a critical consideration. There are ways to potentially minimize or even avoid estate taxes on life insurance proceeds, but proceed with caution. One common strategy is to create an irrevocable life insurance trust or ILIT. By transferring ownership of the policy to an ILIT, you can potentially remove the death benefit from your taxable estate. However, ILITs are complex legal instruments, and it's essential to work with an estate planning attorney to set one up correctly. So remember, death benefits are typically income tax free to the beneficiary, but they could be included in the taxable estate and subject to estate tax. Estate planning can be complicated, and it's crucial to understand how life insurance fits in the overall picture. If you have any questions or concerns, please consult with a qualified financial advisor, tax professional, or estate planning attorney. They can help you develop a plan that meets your specific needs. We have covered a lot of ground when it comes to life insurance and taxes. From MECs to viatical settlements, transfer of value to accelerated death benefits, it's a complex landscape. Let's bring all together with a final recap so you can have a clear understanding of the key takeaways. Let's start with modified endowment contracts or MECs. Remember, these are life insurance policies that have been overfunded, essentially shifting their focus from life insurance to investment. The key takeaway with MEX is the taxation of withdrawals and loans. Unlike traditional insurance, withdrawals and loans from a MEC are taxed on a last in, first out LIFO basis, meaning gains are taxed first. There is also a 10% penalty for withdrawals before age 59 and a half. So, if you are considering a MEC, understand these tax implications. Next, we discussed about viatical settlements. These allow terminally ill individuals to settle their life insurance policies to a third party company for a lump sum cash payment. The proceeds from a viatical settlement are generally income tax free, which can be huge benefit during a difficult time. But remember, this is different from cashing in your policy with the insurance company. We then explored the transfer of value rule. This rule addresses what happens when your transfer of ownership of a life insurance policy um, while you are alive. If you transfer the policy, a portion of the death benefit may be subject to income tax. This is designed to prevent tax avoidance. There are exceptions such as transfers to a spouse or charity, but it's crucial to understand the implications before transferring ownership. We also discussed accelerated death benefits. This provision allows individuals with qualifying conditions like a terminal or chronic illness to access a portion of their death benefit while still living. These accelerated payments are generally income tax free and can provide much needed financial support for medical expenses or other needs. Finally, let's zoom out and look at the big picture of life insurance taxation. Generally, death benefits are income tax free to the beneficiary. However, the death benefit could be included in the deceased's taxable estate and subject to estate tax if the estate's value exceeds the exemption limit. You have to remember this. This is where estate planning comes in. Strategies like irrevocable life insurance trusts can help minimize or avoid estate taxes on life insurance proceeds. As you can see, life insurance and taxes are intertwined. It's vital to understand the rules and how they might affect your specific situation. A final disclosure, this information is only for general knowledge, and it is not considered to be a financial advice. It's essential to consult with your qualified or financial advisor or tax professional and or estate planning attorney to discuss your individual circumstances. They can help you make informed decisions about your life insurance and estate planning.